This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Quickly on the call today, we've got Sally Ilmaz joining us from Dubai. We've got Patricio Alvarez and hopefully Will Hares joining us from London. A little bit of a technical issue there. Fernando Valle in New York City, and myself down in Florida. So if you're not paying attention, the #1 song in America right now is called Rich Men North of Richmond by a guy named Oliver Anthony. Man, that guy has some pipes. It's a great bluegrass track about the plight of working men and women. Great song. Encourage you to give it a listen. In many ways, it's about economic hardship and anxiety. So on that front, I'm looking at the screen today, and oil appears to be about $85 and change. So let's do a check-in on the macro that's feeding into the oil price outlook. Fernando, I want to come to you first. Does 85 feel right, and kind of how are you reading the tea leaves at the moment?
I had an old boss that would always say, the stocks and oil never trades sideways. It always is up or down. So we just know that it won't stay 85 for very long. And our view stays around the demand side of the equation. And what we've been seeing over the past couple of weeks is more of the chatter around China and their real estate market picking up and the impacts that will have on demand. Of course, supply side is fairly well understood. Sally can go into more detail, but OPEC reducing output, that in and of itself creates a buffer, which is spare capacity that would eventually cap the upside. But in the downside, we still think that demand will have the greatest impact. And China, as we see some of the Country Garden and Evergrande struggle to make some of their payments, that will have reverberations across the economy. China is the largest trading partner for Germany, for example. It's the largest trading partner for Brazil, and we will see that ultimately impact oil demand. So we think 85 is probably the peak. It's kind of a resistance level for the remainder of this year. We could see it trade lower if our fears around the economy really come to fruition.
And Sully, I want to get your perspective from the Middle East. Is 85 enough to balance the fiscal budgets for most of the countries in the region?
It depends. It depends on the year and the total spending by each country. And we know some of these countries have been spending a little bit more, which takes those fiscal break-even numbers a little higher. It's definitely a pretty good price. But still, for Saudi Arabia, for example, IMF doesn't think that this would be a high enough price for them to be fiscally breaking even. And perhaps that is one of the reasons that them and OPEC Plus are trying to keep the markets a little bit tighter, perhaps in the rest of this year. But the state of the market, I think Fernando summarized it pretty well. On the supply side, we know they tell us where they want their supply numbers within the OPEC Plus group to be. And I think, when we look at the last couple of weeks, perhaps especially earlier in the month, delivery of those cuts, the extension by Saudi Arabia of that extra unilateral 1 million barrels per day of cuts, extension of that through September, gave a little bit of a momentum for oil prices. But then that was the supply side. As Fernando mentioned, the demand side is a lot less certain. And China is obviously a big factor in this. And some of the economic data that we've been getting in the last week or so, it has been disappointing. So it is, we've been talking about how we expect prices to be range bound. What that range is perhaps can change, but for the time being, we're looking at a range between $80 and $90 a barrel. There is that very aggressive OPEC Plus policy. They've shown that they are ready to cut more and more and more to defend a floor probably around $80 a barrel. But then again, on the upper end, you know, there's the China worries. There's still, I think, generally the global economy and a recession worries that is probably going to cap prices at around $90 a barrel. So again, it's very difficult to read the market at the moment, especially on the demand side. But we continue to do our best.
Thank you, Sally. Will, I want to come to you next. First, is that a Canadian Mountie police officer over your shoulder? But more importantly, I think you've had some of the service names report. How are they? How's the year going for them, and what do they think about the oil macro?
Yeah, just quickly, that is a Canadian Mountie on my mantelpiece. Just a little throwback to my youth spent in Canada, which I look back very fondly on. But as far as energy goes, the energy service space in Europe reported over the last couple of weeks. So that includes Petrofac, Saipem, TechnipFMC, and Subsea 7. And I think the overarching theme here from this results period is that 1H was, I think, a watershed moment for the space. While there's some margin difficulties still working themselves out from some legacy contracts, cost overruns, and poor negative commercial settlements coming through, these are starting to work themselves out. And when we are seeing booming order intake and backlogs starting to surge. And this has been expected to occur given the underinvestment in the offshore energy space, but it's quite dramatic for a couple of the names. And just looking at Petrofac, they had more order intake in 1H of this year than the last 3.5 years combined. So we are seeing an absolute wave of investment in some of these projects in their core geographies and markets, and then of course top line and margin will begin to recover. We think it might take time, but certainly through 2H and into 2024. Keep in mind that this space has been beaten up incredibly badly over the last several years. Not least because of COVID-19 driven delays and disruption, but also obviously the massive downturn in spending from these companies' clients. So we think the offshore energy services space with some of these names, particularly the LNG focused ones like TechnipFMC, are worth a look, and they are certainly positioned to benefit quite well from the uptick in spending, and particularly as Sally and Fernando mentioned, that global oil demand is projected to reach an all-time high this year, and there's no real signs of that slowing down in the near future either. So energy services space will continue to benefit.
Very interesting, Will. I think demand for oil and all forms of energy is actually just running up these days. And so, Patricio, I want to bring you on. One of the trends we've observed as well in both the wind and solar space is growing backlogs. There's a lot of demand for that space, but I do think we're also seeing some challenges, particularly in the offshore wind segment. So tell us what's going on there, and maybe tie it into Orsted earnings, which I think reported recently.
Sure. So yeah, as you alluded to, I think offshore wind hurdles are extending or continuing. I think with the debacle at Siemens Energy perhaps being sort of the signpost for the sector. Nevertheless, Orsted reported a 1H that is in line with guidance, but it was a bit rough, mainly because of the load factors that were weaker in the U.S. There's lower power prices in the U.S. now, mainly because solar is pushing prices down everywhere. And Orsted recently changed their hedging strategy to be more exposed to merchant, so that actually kind of backfired for them. On top of that, we've seen a sustained and sharp decline in natural gas prices, which means that all the sort of gas storage that they procured during last year at higher prices is now valued lower at the spot market. So that also sort of worked against them. The company still has a broadly flat 2023 EBITDA outlook, flat versus 2022, with I think a bright spot being that they are about to close or complete 2 projects this year, and we expect them to also sell a couple of stakes in one of their in a couple of their operational farms. So they're going to sell down 2 farms or stakes in 2 farms this year, and that should help prop up results this year. Nevertheless, that we haven't seen a lot of progress in improving the visibility of their long-term development pipeline, although the targets have not shifted. We haven't seen that the typical sort of reinforcement of the backlog, if you will, and we don't see a light at the end of the tunnel really for the offshore wind industry. But we do have to note that in the sector, Orsted is still the leading company. It still has the most established supply chain base, and I'd say it can be a bit more selective in terms of which projects it can jump into relative to smaller peers.
Patricio, just while I've got you here, let's talk a little bit more about the gas side of the equation. So I think TTF's back up over 30 euros a megawatt hour again. There's a headline on the terminal right now that says Germany expects gas prices to stay high for several years. What's your latest read on how European gas shakes out? And is there going to be enough LNG to balance things?
I think, well, answering your second question first, I think, yeah, odds are that there will be, at least for this winter. Well, the other point is that we did see gas prices return to some sort of volatility, increasing between 30 and 40% intraday a couple of days ago on news that potential strike action could impact facilities or export facilities in Australia for LNG. And while those cargoes would not come directly to Europe, I think the fear is that Asian markets would have to sort of replace that shortfall, and that would take away from the spot volumes that Europe could draw during the winter. And I think it's worth noting that the price went up from about 30 euros per megawatt last week to about 40 euros per megawatt, and is sustained around 40 euros per megawatt over the past few days. Which means that this probably the market is getting a bit jittery about the undersupply in the global LNG market. And I think the other part is that's worth noting is that gas storage is about to hit 90%. It's about to hit the target almost 2 months earlier than what the EU Commission what was hoping for in Europe, and still prices went up by 30 to 40% in a day. So that just shows you that the European gas supply outlook is still relatively frail, and that's because we expect the global LNG market to be fairly tight until throughout the mid-decade, when we will see incremental supply come online.
Will, I want to come back to you. You had a great focus idea last year on Equinor benefiting from the European gas crisis. And I think a number of the global integrated oil companies are highly exposed to gas via various channels, including LNG. And kind of what's the narrative there? Are they racing to capture some of this premium pricing that you're seeing in LNG markets right now?
Well, from the project side, I would say that racing is probably the wrong verb to use, because these projects take many years of planning and construction and design. But where they are capturing value, although less so in 2Q, is from their large trading and optimization businesses. So we've seen what Shell and BP and Equinor have called exceptional results within their gas trading businesses. So this is arbitraging global pricing and optimizing certain cargoes for certain locations. Really leaning on their global portfolios of some of them, including Shell being the largest liquefier and marketer of natural gas globally at about 70 million tons a year. So are they capturing value? Yes. But it's mainly on the pricing and optimization side rather than maximizing supply, which they are if possible. And a good example of this is Equinor through last year, who is the largest pipe supplier of gas to Europe, and they were very clear to the market saying they were doing everything they could to maximize supply, including deferring maintenance. They were halting gas reinjection at certain fields to export, and running their facilities as hot as they could. So the answer is yes, but just not from a real accelerated project timeline. Although there's significant capacity underway being constructed for this entire group.
Solly, I want to bring you into the equation. We haven't done a check-in with you since following Aramco's earnings. So, similar narrative. What are you hearing from them? What's the vibe from some of the Middle Eastern producers?
Sure. I mean, not too much of a surprise in terms of the results. I think pretty much everything was in line. I think the highlight with the Aramco results that I thought was interesting was their performance-linked dividends, which is something that they announced in their first quarter results. But we were expecting this to start next year. And this is on top of the base dividend that they're paying at about $19.5 billion. And what they said was that they will bring a performance-based dividend that will be 50 to 70%. They will decide on where that is exactly, of the free cash flow available after the base dividend, after other investments. So they actually said in their second quarter results that they will begin payment of these dividends in the third quarter this year. And what they're saying is that because 2022 was such an extraordinary year, they want to start paying this dividend earlier. And they will use, instead of the annual results of 2023, they're using the 6 quarters, starting from the beginning of 2022 to the middle of 2023, just so that the good profitability from 2022 is being shared with shareholders. So there are two sides to this, I think. I mean, on the one side, we have been writing on how the dividend yield of Aramco is actually trailing global peers. I mean, in absolute terms, of course, this company is paying a lot of dividends, $75 billion in 2022. But given their market cap of around $2 trillion, their yield was actually much lower than its global peers. So this performance-linked dividend obviously helps push their dividend yield higher, closer to global peers. But at the same time, I think important to remember that a big chunk of these dividends are going to the government. And going back to your question before, oil prices are at 80, 85. Is this high enough? It actually wasn't going to be high enough for Saudi Arabia to have a budget surplus this year. But having a big extra dividend payout that's coming from Aramco, now actually they will be in a budget surplus at the end of this year, according to the Bloomberg economists' calculations. So I think there's, of course, the shareholder, international shareholder story to it, but at the end of the day, we know still 90% plus of these dividends are going back to the government, which in this year will help them balance their budget and be in a surplus. But I think that was the highlight operationally. I mean, they've said pretty much what we've been hearing from the global majors, just softening earnings in pretty much every segment. Obviously, chemicals is very important for Aramco now, given their SABIC acquisition, and in the petrochemical space, of course, I mean, the health of the petchem space is a GDP proxy. The economy not doing great, the economic forecasts being kind of fading away hasn't been great for that sector. So softening results in the petchem space as expected as well. But again, this was all in consensus. This was all in expectations, and I think broadly speaking, results were pretty much in line with the street's expectations in the second quarter.
It's very interesting. I think some of the GDP forecasts are all over the map. U.S. Maybe it was just the other day. I think it was maybe the Federal Reserve is talking about 5% in 3Q, and so it's really hard to triangulate on some of these things. But Fernando, I'm sure you got an opinion on that specific question, but I know you had Suncor report the other day, so let's swing around from Saudi Arabia to Canada. Tell us about Suncor, and feel free to tell us if you got any views on 3Q GDP as well.
Sure. I'll just say, the Saudi's numbers probably don't account for the Neymar signing and the 400 million pounds they spent just on that one guy for 2 years, and all the other soccer players they're buying, it's hotcakes. But yeah, on Suncor, it was interesting. It was a very strong operational quarter. Their refineries picked up on utilization factors. Their upgraders are also running higher. But what's most interesting is they've reshuffled their whole executive team, not their whole, but a lot of their executive team. And it's just one of the key moves that Rich Kruger, the new CEO, has made over the past couple of months. Suncor, if you go back to the Steve Williams days, they were really known as the strongest operator in the oil sands. It's why everyone was excited when they bought Canadian Oil Sands, when they acquired additional stakes in Crude, because they could then make that project run better. And to their credit, they have, because the bar was very low beforehand. But then they saw issues across their portfolio, including some very sad facts, including fatalities and others. So Rich is really a no-nonsense. If you listen to his calls, he's really very direct and to the point, bringing that old ExxonMobil mentality of low risk, deliver on execution, very similar to what Steve did in his early days at Suncor. And so if he continues to improve the reliability of the operations at Suncor, we think they have the biggest potential in the oil sands, just because it's the most well integrated. They have some of the better minds and better resources within the group. They had just not performed well at all. The only part of concern there was Suncor didn't cover all of their distributions. They distributed about $1.4 billion in Canadian dollars, and they generated just over $1 billion in free fund flows after capex. So it's still a little bit of catch up, but if they continue to perform as it is right now, they should reach that parity in the second half of the year.
Okay, thanks, Fernando. I want to shift gears a little bit and talk a little bit more kind of strategic here for a second. There was a very interesting story from yesterday on Occidental. They're buying a company called Carbon Engineering. They're a direct air capture, carbon capture company, from my understanding. Our colleague Vince Piazza covers Occidental, and he's got a react, so make sure you check that out. But I want to just get a sense from this group here. When you look at some of the long-term scenarios from IEA or the IPCC or almost any group that sort of considers anything related to the energy transition, many of them do seem to kind of have a placeholder in there for some kind of carbon capture technology coming into the mainstream over the next couple of decades. So, Will, I think some of your companies talk about that on occasion. So let's come to you first. You know, where's carbon capture, whether it's just more traditional CCS or direct air capture, where's it going to fit in the equation, in your opinion?
Well, I think there's a very clear bisecting happening within at least the global oil major space, with the U.S. Majors, Exxon and Chevron, much more interested and active in carbon capture space. I think quite clearly strategically, as this is a much more adjacent technology to their own existing sort of business as usual operations. Whereas although the Europeans are exposed to carbon capture as well, it's much more diverse. You know, we're seeing big moves into renewable power capacity, big hydrogen projects that are underway. So it's a much more diversified, many fingers in many pies as far as the energy transition goes for the European majors. And for direct air capture, this is a very nascent technology, and the economics of it are very questionable at least at this stage, and probably for the foreseeable future. You know, you're looking at several $100s per ton of carbon removed, and the scalability as well obviously is there in the long term, but existing direct air capture projects, namely Climeworks, which has an operating one in Iceland because of their very cheap geothermal power, is still an absolute drop in the bucket for you know, countering and offsetting the emissions from, you know, something like 1,000 cars a year. So while the concept is promising and interesting, the economics have a very, very long way to go.
Yeah, just to weigh in there, if for anyone who's not following the European carbon market, current price looks like it's 88 euros a ton, well below the kind of levels you were just describing there, Will. So I think you know, carbon markets aren't thinking about this yet, but let's see how those evolve. Fernando, let's get you to weigh in on this as well. I know we always talk about that transatlantic divide, but you know, what's your sense on CCS and where it might fit in the portfolio?
Yeah, absolutely. I think, you know, Exxon has been probably the biggest mover in that side of the equation. They acquired Denbury just now exactly for their CO2 business and their CO2 pipeline. But they've been very open that direct air capture is probably a decade or more away from being feasible, and certainly at the current costs, even even with the benefits from the IRA, you're still very far. The IRA gives you about $45 a ton, so even with the carbon credits in Europe being at 88, you're still around only under $130. Excuse me. I think what's interesting is really the heavy emitters, because of course they have a much bigger contribution to carbon emissions, and that's where Exxon is focused at right now. And in the two hubs that they're building one in Louisiana, one near Port Arthur in Texas, and creating those with the high emitters, you know, concentration of cement plants, refineries, smelters, and others that can take that carbon directly from pipes where it's much easier to capture them and then move them through the pipeline into Danbury's existing enhanced oil recovery projects in northern Louisiana. And you know, Oxy is also a large enhanced oil recovery user for CO2 lift in West Texas. So clearly there's some tie-ins there, but you know, direct air capture for us, it's going to be not cost competitive for a very long time. But you got to start somewhere, and someone needs to take that plunge, and I guess that's where Oxy is going with it.
Patricia, let's swing over to you next. Any companies in utility land talking about carbon capture and storage recently?
Yeah, so I think on the whole, well, we cover mostly electric utilities, so on that front, not many. But the companies that do have exposure to either gas-fired power have been marginally talking about this. So companies that have gas-fired power or lignite or coal-fired power generation have started talking about this carbon storage sort of solutions. You're talking about Centrica and Uniper and these types of gassy utilities. But the overarching story, I think, for now remains a pivot towards hydrogen solutions, and I think that's also reflective of the policy in Europe. I think the EU's let's say answer to the Inflation Reduction Act, which was the Net Zero Industrial Act in Europe, is proposing or mandating a target of capturing at least 50 million tons by 2030 and 550 million tons by 2050. And it's interesting to see that mandate actually asks for oil and gas companies to be the ones who repurpose their gas caverns and empty gas fields to store carbon. So I think again it's something that will have to play a bigger role in the oil and gas space rather than utilities, where there will be only sort of select applications with renewable power still being sort of the main driver.
Sally, let's get a check-in from you. Middle Eastern oil patch, where's CCS fit into the discussion, if at all?
Sure. So coincidentally, and I think quite interestingly, there was another piece of news from earlier this month on how Occidental and ADNOC are actually have agreed to review carbon capture investments in the future. And I think, I mean, ADNOC probably speaks for the rest of the NOCs in the region, but I think is especially an interesting one because ADNOC is the national oil company of the United Arab Emirates, which is hosting COP28 later this year, and as part of that, they've accelerated their climate targets. And as you said earlier on, I think in many oil and gas companies, what we're seeing is that they embedded somewhere within their climate targets, they do have a placeholder for carbon capture, but we know the NOCs in this region, like ADNOC, like Aramco, have blue hydrogen plans as well. So I wouldn't be surprised that if in the next couple of years they do announce, I suppose, similar to Oxy and perhaps together with Oxy, some more investments in this space, especially as they accelerate their kind of net zero targets around the COP28 event that they seem to be quite excited to be hosting later this year.
Okay, thank you, Sally. We've got one more topic, and it's a Fernando one, so we'll squeeze it in. Fernando, I think one other company that you had report the other day, YPF, tell us what you heard, and I think you've got some tie-in to the upcoming election in Argentina later this year as well.
Yeah, YPF is certainly very interesting and topical right now. Their earnings, again, solid operations, some growth out of Vaca Muerta and the shale there, but still not generating free cash flow as was expected. They're investing, especially in infrastructure, to debottleneck the Vaca Muerta. And then, of course, they have some pricing restrictions, self-imposed, not government at all, as the management has told me. It's self-imposed, even though the government is the controlling shareholder of the company. But what's most interesting is the first round of the presidential elections took place this weekend, and the libertarian proto-anarchist, as self-described proto-anarchist, took the most votes, and he's very much about deregulating and removing the shackles on the economy, including YPF, and that sent the shares soaring after the results came in. And it's quite interesting because prior to the current administration, we had Mauricio Macri in Argentina, was also a market-friendly president, perhaps not as anarchical as Javier Milei, but still very much about deregulation. And he wasn't able to do a lot of the changes that he expected. In fact, he put in some of the price controls that we later saw it as a self-imposed change, but he still put them in place, and capital controls, because it's a very difficult situation with inflation in Argentina. We also saw the central bank devalue the currency even further, and that will all have impacts on the ultimate profitability of YPF, since they price everything in pesos, but they still import fuels from abroad.
I gotta say, I've met the Argentinian Secretary of Energy, Flavia Royan, earlier this year, and one of the discussions that she was talking about is the opportunity for shale oil and gas production in Argentina. What do you make of that? Is Argentina the one place outside of the U.S. where we might see some shale oil and gas really come to fruition?
Well, it already is. Vaca Muerta is over 150,000 barrels a day of crude production, and it is a stacked reservoir similar to the Permian, has very good geological features, and very similar to the Permian. It's land with very low competing uses. It's mostly a desert, and it was the home of the initial production out of conventional production out of Argentina. So it benefited from already having infrastructure in place. But now it's really about attracting investments. If it was purely on geology, there's no question that the Vaca Muerta would compete at the top end of the supply cost quartile in the global cost curve.
All right, I think we'll have to leave it there. I want to thank everyone for joining us. We hold these calls on the first and third Wednesday of every month. So the next one, just after Labor Day, September 6th. We hope you join us on that day as well. We regularly get the team together here, but we're also interested in hosting external speakers that you'd want to hear. So give us a shout. You got someone you think should be on the call with us to share their views on the world. We're very much open to that, and want to thank you for your time. And we're all green dots on the terminal right now, so shoot us an ID if you've got any follow-up questions, and I hope you have a great week. Take care, everyone.